thank you to Firepower for presenting this morning. Thank you to Sagar and Derek, co-presidents of the Mississauga chapter, for hosting this today and organizing it. My name is Bram Elkin, the head of the club. We operate out of Montreal, and we have 19 chapters, 1,000 members. It's still growing, believe it or not, with new members. Every week we have a new member too. It's very satisfying. In any case, I'll have a few announcements at the end, but I'll let Sagar introduce Trevor and Moritz, and we look forward to your questions after.
So folks, thank you for joining us on this sunny noon on Wednesday. We have an exciting presentation with our friends from Firepower Capital. I want to give a quick shout out and thank you to Moritz for help putting this together. So our speaker this afternoon is going to be Trevor. Trevor Simpson leads the Firepower Capital's private capital division in client engagement and credit underwriting. Trevor has extensive experience in structuring cash flow transactions and providing patient capital to clients utilizing senior term subordinated debt and mezzanine financing. Prior to joining Firepower, Trevor worked at Roynat Capital, where he managed and grew a portfolio of clients, tailoring long-term capital solutions for mid-sized companies. Trevor's utilized creative structuring skills and the offering in the Firepower Capital arsenal and deals with mid-market firms across Canada, especially ones in the tech sector, by providing non-dilutive growth capital to rapidly scaling companies. So impressive resume there. Trevor, thank you so much for taking the time to share your information and insights with us. I'll turn it over to you. And as Lorene mentioned, if you have any questions for our listeners and guests, please use the Q&A feature and chat feature, or raise a hand. And when it's appropriate, we'll allow the guests to come in and speak and ask the question live.
Perfect. Thank you, Sagar. Thank you, Mo, for setting this up. So I put together a PowerPoint I'm going to run you guys through, and hopefully all of you can see that now. So I'm Trevor Simpson. As mentioned, I'm an associate partner at Firepower, where I'm leading the private debt division. So we've got 60 minutes scheduled here, but I think where the most value comes from these is in the questions that get asked and that answered. So as I'm going through this, if you have questions, as mentioned, just send them through the Zoom. I'll only speak for 25, 30 minutes, and then I'll turn it over to Q&A. So I've given a bit of a background on myself. Been at Firepower for over 4 years now. Joined as an associate director 2 months after the fund launched. So I've been here since the beginning and loving it. And I oversee the day-to-day operations of the fund. So I'm intimately involved with everything from speaking with prospects through to fund management, alongside the 6-person team here at Roynat Capital prior to that, which is owned by Scotiabank. And they're sourcing and underwriting cash flow and mezz transactions in the commercial lending space, or the risky part of the commercial bank. And prior to that, doing an MBA at DeGroote. So through these experiences, I've got a pretty good understanding of the types of borrowers across their different life cycles, and where and what solutions exist at different parts of the capital stack. So here's an overview of what we're going to chat about today. I've watched presentations before, and I find the most value comes from learning as opposed to me just blabbering on about myself and the fund. So I'm going to give you an overview of Firepower, but then get into some of the trends that we're seeing, as well as discuss tech and traditional businesses and where private debt can play a role. So who is Firepower? For anyone who doesn't know, we're really 3 things. We are an investment bank, a direct lender, and a private equity shop. But backing up a bit first, we started as a family office in 2009, looking to diversify our parent company's holdings. Parent company was MPI Group, heavily involved in real estate, listed the cap REIT on the TSX, and this was a way to diversify outside of that. Our CEO, Lon, was responsible for equity investments as a way to diversify, but found doing 1 to 2 deals a year was quite slow, and was looking for more action, and really found a niche in advising clients in the lower mid-market. So fast forward a bit, Firepower incorporated as a separate entity and launched the advisory practice in 2013, focused predominantly on M&A sell side, selling companies with an enterprise value under 150 million, kind of that lower mid-market in Canada, where banks weren't showing as much love back then, just given smaller fees. This group has since closed 63 transactions, predominantly M&A sell side, but also some capital advisory. And through the capital advisory mandate, we realized that in Canada, the banks here are largely asset-based lenders. So if you're an asset-light business that doesn't have equipment or collateral to pledge, it's quite difficult to get meaningful amounts of financing. And then on the flip side, when you're looking to grow, equity is quite expensive given the dilution, especially when you're scaling up. And in the middle, there's not a ton of options. There's some family offices and private lenders, but a real lack of institutionalized capital. So we saw this gap. We launched our first fund back in 2016, to fill this gap and really coined it our gap debt fund, really providing entrepreneurs an alternative to equity, allowing them to continue to grow without diluting. So in the simplest sense, if you're an entrepreneur, instead of raising equity at 10 million this year, take our debt and raise it 25 million in 3 years, and we'll finance that working capital burn. So tech companies love this. It allowed them to continue to scale and keep more ownership for themselves. But we've evolved quite a bit since. So in this product, we now lend 1 to 15 million in check size, still providing working capital to tech companies, but also looking at M&A financing, bridge capital, refinancing shareholder loans, taking chips off the table, and even distress and turnaround situations. So it's quite a broad mandate. And we look at companies all across Canada. We're located in Toronto, but with a satellite office in Montreal. And our current portfolio is about 60% technology, but we're industry agnostic. We're lending against enterprise value, and we're focused on an entrepreneur first, investor second mentality that clients seem to love, bringing common sense into our lending practice. And then just to wrap up, we also launched a private equity division 2 years ago. Did our first 3 deals on balance sheet and saw real success as operators getting our hands dirty. So we launched a fund that we finished raising in November, and we're now deep in legals on a couple files that, touch wood, should close in the next few weeks. And the premise here is that we're looking for companies we can add real strategic value to and get involved with, focusing on businesses with an EBITDA under 5 million or distressed businesses where we can work with management to turn them around. And you might be asking how we're able to launch all these different divisions. And the answer to that is really the origination engine we've built. So what Firepower has built since inception is an origination engine leveraging Salesforce, where we've nurtured well over 30,000 companies, enriching the data with each conversation we have with them and leveraging different tools and technologies available to continue to bolster that. 250,000 lines of code in Salesforce, a team of over 9 individuals constantly updating this for opportunities in each different division, being investment banking, lending, and equity. And what this does, it gives us an excellent pulse on the market and where trends are moving for each. So as I mentioned in summary, we're really 2 separate divisions: private capital, looking at debt and equity. We've got 34 deals closed, 380 in live deals now. And then the advisory, sell side, buy side, and data-driven strategic initiatives. I'm not going to go through this in too much detail. We've had good success over the past few years. We're now above 40 people and launched a number of different divisions. So let's get into it. So we've noticed several challenges that borrowers face, and it's resulted in our product being successful. So when you look at the Canadian market today, our view is that there's an increasing portion of growth companies that don't have significant tangible assets. This is changing because there's a lot more technology and tech-enabled service businesses out there, but also there's a number of services now that companies can outsource to reduce the need for CapEx. And the common theme here is that there's a lack of tangible collateral bases, which creates challenges for traditional lenders when lending to them. Another challenge is that spending on growth hurts debt service coverage ratios, which are often used by traditional lenders. So many businesses spend on tech, people, marketing to grow, which hurts their EBITDA. And the EBITDA is generating ROI, but it's also used to debt size the business. So as they continue to grow, it's hurting the ability of debt that they can actually borrow. And what this is doing, it's creating an increasing disconnect between enterprise value of companies and their debt carrying capacity. Traditional businesses may have grown on EBITDA in the past, but more and more today, companies are trading on multiples of revenue. So they're incentivized to burn today, to lose money, to increase the value of their business, but it's not reflected by traditional lenders. So what is available? I won't go through all of these in high detail, but where we see options are, banks pretty limited appetite for growth situations. It's, again, lending tied to earnings. Asset-based funds, it doesn't make sense because we're talking about asset-light businesses. In terms of cash or tech debt funds such as us, we estimate there's about 7 or so focused on that 1 to 15 mil check size. VCs are available here. They're generally looking to back big ideas. So sometimes there's competition. Minority PE for small deals is quite limited. Family offices generally don't have lending practices. They're almost always focused on equity. High net worth individuals looking for deals under 500,000. The BDC and the EDC represent the largest source of growth in this segment for sure. But based on some customer feedback, we've heard that it can take time to secure and it can be expensive. Fintech, it's definitely made inroads. It's still, $500K, maybe $1 million in some cases, but it hasn't grown in size. And then SaaS lending at the banks, almost every bank now has launched a tech practice, but in almost every case, you've got to have a large VC or PE as a shareholder, which I'll get into later. And then for non-Canadian lenders, we've seen there's very little appetite for deals under 15 million. So what this has created is a challenge where many companies fall outside of the box of traditional lending. Here at Firepower, our gap debt product focuses on that 1 to 15 mil check size for asset light, lower negative EBITDA companies that are growing fast. They have reasonable potential. They don't need to be a unicorn. Maybe they grow to 50 million and that's perfectly fine. And they're often bootstrapped, meaning they haven't raised outside capital from VCs or private equity funds. And there's usually an urgent need for the capital, whether that's growth or it's transactionary in nature. But beyond that, who we lend to is really companies that have a robust business plan showing us how our capital is going to be used to generate a return on investment. We obviously like sticky, recurring, and repeatable revenue. And we, post-COVID, we've now focused almost exclusively on need to have products and services as opposed to nice to haves. And we like when companies have the ability to cut expenses not tied to growth so that they, without materially impacting the business. Little exposure to cyclical or hype industries, and a preference for B2B, SaaS, or service. And this is where we specialize with our gap debt product, and that's what I'm going to be talking about today. So a number of these challenges existed prior to COVID, but how did COVID affect these challenges in the market? So it started with a real lack of growth and acquisition capital as banks and VCs focused on existing portfolios last year. So when the lockdown first began, there was very, very few entities writing new checks. Credit committees at banks tightened up almost all but stopped lending to new borrowers. We saw VCs back off from new deals, focusing on recapitalizing their portfolio. And through this, we saw a number of Series A and Series B raises fall apart, as well as several broken M&A processes where buyers couldn't get the bank leverage they needed anymore. Because of this, lenders and investors across the market largely focused on their existing portfolio because no one knew it was going to happen. The government eventually came out with several programs. They did a great job supporting businesses, leveraging the BDC to roll those out. But demand was extremely high, and so was the backlog. And a lot of this focus was on companies that desperately needed capital now to survive. So there was few options for companies who had capital, who were okay. They had runway in their business, but they needed to grow and needed capital to do so. And so we saw a number of companies turning to private debt for that solution. And through this, we had a huge inflow of interest from brokers and accountants, lawyers and entrepreneurs who were discovering and learning about the benefits of private debt, some for the first time and some catching up on it. A tremendous number of phone calls Q1 and Q2 of last year. And what came from that is that they realized private debt has a lot of flexibility. It can be much less expensive than equity, more expensive than debt, but it's the flexibility that a lot of people were looking for. And it resulted in a growing market-wide comfort with this asset class. And through that education, private debt is now becoming much more common, especially when companies are growing. And although VCs are very much back in business now with plenty of dry powder, banks still haven't returned to pre-COVID leverage levels. And we've seen, same with speed, and we've seen companies turn to private debt when they need to move quick and close a deal, and they can't wait. They need to get it done. They want to lock it up while the LOI is in place. But more so, we're seeing that the market really understands the cost benefit of private debt, and we've never been busier. So that's a bit of background on what we've seen or how we see the world through the lens of asset-light businesses, as well as some recent trends. But for today, I really want to speak about both tech companies and traditional businesses alike. And I thought I'd provide a 30,000-foot view of the industry for technology or tech-enabled companies in the Canadian market. And I'm going to go through each of these stages, and I'm certainly generalizing here. Every company is different. There's always nuances to what I'm saying, especially around dollar amounts or the growth path companies can take. It certainly varies on the type of business. But I think this will be a really helpful starting point in setting the stage for where Firepower can provide value, but also for what other options exist for companies. I think it would be ridiculous for me to sit up here and tell you Firepower is the best and only option for growth, because there's plenty of options depending on a company's needs. So starting with pre-seed or idea phase. So this is the first stage. It often requires the founder detailing an initial idea, prototype, or mock-up. It usually happens while that entrepreneur is working a different full-time job, often called moonlighting, so they can support themselves and their side hustle, their new business. And once an idea or mock-up begins to emerge, they start some market testing, speaking with trusted advisors or potential customers to substantiate the idea. And the company may need capital at this stage. It may not. If it does, it usually comes from the founder or friends and family. It's quite hard to value a company at this stage, given it's still focused on exploring the feasibility of an idea and whether it can actually be built into a product or service. So valuations are usually quite low and friendly. There are accelerators like the DMZ and Next and Highline Beta who can provide support. And in some cases, they'll even give you an investment into fairly early stage companies, as well as early angels such as Angel Investors Ontario and York Angels, who are trusted advisors that are helpful through the life cycle of a company. And business might only raise 50 to 200K to get off the ground. It's almost exclusively from equity. So the next stage is the seed stage. So, excuse me, this stage requires the entrepreneur to test their product and service in the marketplace at a low cost. And to do this, they create an MVP or a minimum viable product. And that product has bare minimum functionality, really just enough to get some meaningful feedback. But it also helps to determine the demographic of the customer, build some traction around its use case, and validate the idea phase. Valuations here are very hard to agree upon. Companies often raise through either convertible notes or safes. And a safe stands for simple agreement for future equity. And safes are generally easier to set up than convertible notes, and they work such that investors are provided the right for future equity, but not until a round is priced by a VC or institution, typically with some sort of cap on the valuation in the next phase. And then similarly, convertible debt is another popular option at this stage. It comes with the benefit of an interest rate for the investor who's providing the capital, and also allows a conversion into equity, again at a discount, when a third party values the business, when an institution comes in at the next stage and values the business. Both are indicative of the early stage nature of the company, and it doesn't give a true value for the business, it just creates a cap. Number of investors here, there's some micro VCs like Extreme Venture Partners or Plaza Ventures. There are also government grants focused around creating jobs and innovation like Sophie and ACOA. There's a number of these, and most are region dependent. If entrepreneurs have the time and willing to jump through the hoops, this is almost free money, and it's worth exploring. Crowdfunding also becomes an option here, and Front Funder is a great tool for this. It allows individuals like myself and you to participate in 5 to 50K increments through their platform, filling out $1 million round, and they take a piece of that. And then there's also a number of royalty-based lenders here, such as Tamaya, Lighter Capital, Clearco, and Flow Capital. They play a good role at this stage, where they take a piece of revenue that comes in every month, and they pay down principal and or interest in exchange for providing non-dilutive debt. It's typically expensive capital, but it's usually cheaper than the equity that you would have to raise instead of that, and allows for less overall dilution. At this stage, a company might range anywhere from 500,000 to 2 million, but it's generally advisable to do this over multiple rounds, often called seed plus or seed extension rounds. And what this does is it allows the entrepreneur to garner better valuations each time, to prove out the business, and to make forecasting become less difficult, which then allows the introduction of some of these lenders. And the addition of an angel investor or advisors is also worth considering. It's a cost of equity, but for first-time founders, it can be quite valuable as they're figuring everything out. And I know I mentioned before, but I'm very much generalizing here. I've seen seeds as little as 200K and as high as 4 million. So Series A, this is the big stage. This is when a ton of options become available for entrepreneurs. The company is now, they've entered scale up stage. They've product market fit. They've recruited a team, several customers, and they're looking for capital to continue expanding and supplement that working capital burn, but also the impending increase to the burn. This is the size, as I mentioned, where a ton of VCs start to become interested, but it's also the stage where private debt can start to play a bigger role. So it's important for an entrepreneur to decide whether debt or equity makes sense as the next step, given the dilution equity could bring. So I'm generalizing again here, but VCs usually look to hypercharge growth when they join a Series A, spend all of the funds in the next 18 months, massively grow top-line revenue, hire a ton of employees, and increase the overall valuation before the next round of financing, and just roll that forward. And this makes sense for some companies and entrepreneurs, especially those that want strategic help, the corporate governance and controls, the cash, obviously, and who are willing to give up equity for the support. But for other companies, private debt can make a lot of sense. So as lenders, we aren't looking for that hockey stick 100% year-over-year growth. We're quite satisfied with 20 to 60%. But it also makes sense for entrepreneurs who don't want to dilute as heavily before getting a higher monthly recurring revenue. MRR is the is what the valuation trades on. So increasing that quite helps get a better bang for your buck. But it also makes a lot of sense for companies that know they're not going to be the next Canadian unicorn, and they want to own more of their business when they do sell. As I've said before, not every business will grow to be $1 billion, and plenty exit at 50 to 100 million. That's perfectly fine. Using private debt, you can own more of your company when you do exit. Outside of that, yeah, again, extending valuation or providing time to achieve better metrics on which to raise on in the future. And if you're looking for strategic capital, you can always layer on private debt as part of a round so that the overall dilution isn't as high, but you're getting that strategic nature. Some of the funding sources here, there's a number of VCs. There's Relay Ventures, Real Ventures, Rhino, just coincidence, they all start with R. There's a number of lenders like us. So there's Firepower, First West Capital, Espresso, and there's a tremendous number of sponsor-backed lenders now. So Silicon Valley Bank really started this practice many, many years ago. And most of the Canadian banks now have a sponsored-backed lending practice in tech, which I'll get into in the next slide. And in terms of funding expectations, anywhere from 2 to 15 million plus. Valuations range widely, but 10 to 30. Really, dilution is somewhere between that 20 and 40% mark. But again, I've seen Series A's that are 40 million and up. And I stress product market fit here, but I am generalizing. There's absolutely companies that don't have product market fit. There's companies that don't even have revenue at this stage for that matter, but they're often in health, some sort of health tech, or it's based on IP, and that's not common for us, and it's not somewhere that we specialize as Firepower. So Series A. So here I'm going to talk about where debt can play a role and give you a couple examples of deals that we've done. And I start with sometimes companies will get ludicrous valuations and equity makes all the sense in the world. But if a company isn't, in most every other scenario, if the entrepreneur understands the drivers of their business, debt is always cheaper than equity. Outside of being cheaper though, it can also help a company when it needs a bit more time to achieve better valuation or better metrics rather, such as lifetime value to customer acquisition cost. Or they may need higher MRR to achieve those tier 1 VCs and get a better overall valuation. Really where we make a lot of sense is plugging a hole, providing you more time to get a better valuation, a better bang for your buck. And that becomes increasingly important because there's multiple expansion on annual recurring revenue. Excuse me. So this changes all the time, but in a Series A at 2, 5, and 10 million in annual recurring revenue, your multiple expansion increases when you raise. So it could be the difference of 4 times your ARR in terms of valuation to 10 times. So it can mean a seriously stronger valuation the more time you delay when you do end up raising. Other ways that debt can help is just providing more working capital and more time to expand into a new territory. So if you expand into the States, for example, but prior to a raise, it automatically increases a company's immediate addressable market, and it can allow you to leverage that when you're talking about growth expectations in your series raise. Debt can also help, obviously, with acquisitions as well. Beyond this, debt also creates optionality on when to raise. So oftentimes we see this where companies are growing. It's not at the level that they expected, and they can avoid dilution by taking debt, and then they have the option of when they want to raise, when metrics might make sense or MRR increases, but they're not forced to keep the lights on. In addition, sometimes when negotiating with VCs, they know you're burning capital. So if you continue to burn and they're dragging their feet on negotiations, eventually you have to raise. I'm not saying every VC does this, but we have seen it before. When you have debt in your back pocket there, you've got a third party that can continue to finance you through those valuation negotiations. And as mentioned, lenders such as us are quite comfortable financing working capital burn because we're lending against enterprise value, and really what drives that is growth in your top line. So senior charter bank financing often isn't available at this stage in a meaningful size above that 1 to 3 million mark, but it's only available in most cases when the company is sponsor backed, meaning there's a tier 1 venture cap firm or PE firm invested in the business. And what this has done is resulted in a unique opportunity to use a lender like Firepower and then transition to a sponsor backed lender when you're raising. So to give you guys an example, we were looking at one of our portfolio companies prior to us working with them was looking to raise a Series A. They were only getting valuations around the 10 million mark, which they weren't overly excited about. Raising 4 million on 10 million is a pretty big dilution. So we came in and we gave them a $2 million facility, which provided runway for another 14 to 16 months or so. But we gave them capacity to borrow up to 4 million based on 10 times monthly recurring revenue. The way that we work is we're term debt. you grow into your facility, so you have access to more capital, but you're not paying interest on what you don't use. And they love that optionality. It allowed them 3 years of optionality there. But by the end of year 2, and we're in this process right now, the company's MRR has increased by over 85%, and they're in final discussions to finalize that Series A round. It's well above 20 million. And what's interesting is that they're speaking with a few of the Canadian banks here who are going to come in and provide them a facility of 2 to 3 million that takes us out. So essentially what they're doing is they've now increased their MRR over 2 years. They're swapping our debt for very cheap bank debt, and all the equity that they're raising is going towards growth. So this is a great tool for companies, and we understand firepower might be a wedge or a bridge product for companies, and we're comfortable with that. But this is really where we thrive. This is where we can provide meaningful value to companies. We're not so great prior to that pre-Series A, 1 million in annual recurring revenue. This is where firepower plays. So just wrapping up here on the tech side. So after Series A, a couple options exist. The most traditional route is you raise your Series B, C, D, you bring on some sponsor-backed debt financing, and then you go the traditional IPO route to create liquidity for founders and investors. More recently, SPACs have become quite hot, although less so in the last few months. And RTOs, or reverse takeovers, have always been popular in Canada. Not every company is going to be a unicorn, so many will sell after Series A or Series B. And oftentimes, companies are created to be sold for larger organizations. Instead of building the tech, they can buy it. And that's how companies might exit. Or maybe they're targeted by a roll-up or acquisition strategy that we're seeing across many spaces right now. But what about companies that fizzle out? That fizzle out. So I mentioned valuations are really very high right now, but so are the expectations that come with that. So if a company doesn't live up to those expectations, they become what's called fallen angels. Performance hasn't lived up to forecast, and they're often disbanded by VCs. This may require raising funds again during a flat year, which is really a down round and hurts investors. But that's also an opportunity for debt to come in to provide additional time to get this company back on track and manage through a flat year, really helping them to raise in future years or perhaps get closer to profitability. Similar to this, debt can also make sense for companies with punitive convertible notes resulting from a lack of growth. I'm sure we've all seen those decks where there's a monster total addressable market, but many times post-Series A companies find out that their market isn't as big as they thought it was. They're not sure what to do, and they might need to sell at that point in time. And then other companies, they might not have the growth potential, but they could be quite profitable. Those become cash cows, where it's important to cement positions with current customers and cut growth expenses. So that, again, quite generalizing, but it covers the tech ecosystem from what we see at Firepower. Nuances to each, but it's a good overview. And from that, I'm going to switch gears a bit, talk more about traditional businesses and how private debt can play a role here. And some of these examples will still apply to tech companies, as you'll see. You'll also notice that a number of these are transactional in nature. Really, private debt makes a ton of sense when there is some sort of transaction or transactional need. So growth through M&A. So as previously mentioned, the credit market is much better than it was a year ago, but traditional lenders are still struggling on speed and leverage, and they're not back to pre-COVID levels. So this has held up some M&A processes as the size of the senior facility or the covenants proposed are not attractive to purchasers. And private debt can play a role here because we're able to move quickly, so the deal remains exclusive and locked up. We can also be a bridge lender, which I'll detail in a second. Another good point is that we aren't inhibited by EBITDA multiples. We're lending to enterprise value. So a good example of the both is we looked at a company a few months ago that needed to close in 60 days. The leverage on close was 5.25 turns, so traditional lenders weren't comfortable, but the actual enterprise value was 9 times. So we found comfort there. Further, there was a contract in place that was going to bring leverage down below 4 times about 12 months from close. And the sponsors who were purchasing this business saw us as a great 2-year bridge to close the deal, assist with some further financing, but then to take us out with a senior once EBITDA had increased. And given the amount of M&A activity going on right now, we've seen this for a number of opportunities lately, where we're either a bridge partner, we help them get a deal done, they realize some EBITDA synergies, maybe they get audited statements, and then they refinance all or a portion of us with the bank in 2 years because they see this as a 10-year play. The other option is that there's M&A activity, we acquire one company, but they've got a list of 20 more they want to purchase. So we help with several of those acquisitions over the next 3-4 years, providing more leverage than a traditional lender would, meaning less equity needs to go in from the sponsors. And then we're taken out by a bank, 3-4 years from now. And really, it's that flexibility that private debt can provide. Other times, COVID has hurt some companies. So a number have been hurt. They've been slower to come back. This can result in borrowers being pushed offside certain covenants and moved into special loans departments where there might be additional reporting or potentially consulting fees that are quite costly. But as a private lender, we aren't forced to use traditional covenants that may not make sense for businesses at that current stage. And we can also be more patient and look to extend the time needed to get back on track before moving these companies back to a traditional lender. And an example of this is we looked at financing a deal that before COVID, they had convertible debt in place, and it was going to convert upon certain growth milestones. However, if those milestones weren't hit, the debt would convert into 25% of the business. Obviously, COVID took place, so the entrepreneur was in quite a bind. But where we found comfort is that we were able to move quickly. We saw leverage as quite reasonable at 4.5 times, and we closed this facility, refinancing the convertible note to avoid that painful dilution. And we're likely going to get taken out by a bank, if not at the end of this year, then the start of next year. Another place where private debt can play a role is MBOs, so management buyouts. Sometimes these can be difficult for traditional lenders to support because it's cash in and cash out, increasingly so in the current financial climate. And we've seen many baby boomers lately who are looking to sell their businesses now that, hopefully the worst of COVID is behind us. Many saying that through COVID, they've realized what's important in life and it's not working all the time. They don't want to restart and regrow it. So they want to start the transition process of retiring. And middle management makes a great purchaser, but oftentimes they don't have the capital needed. They're often younger. Founders also quite often want to keep their legacy intact and make sure their people are taken care of. So middle management is a great group to sell to. So what private debt can do is just allow for greater flexibility on using capital for this. We're a lot more flexible on cash in, cash out because we're lending to, again, enterprise value. And oftentimes here we sit behind existing lines of credit that over time will grow to take us out. So a couple more on public companies, especially small caps on the TSXV and some OTC companies. The market is a whipsaw and can present challenges with the movement of share price, often resulting in complex cap tables or messy convertible note agreements. And when prices are depressed or the company's market cap isn't reflective of the business, which for small caps is the case often, private debt can make a lot of sense as part of the growth strategy. And where we fit here is we're far less dilutive than converts. We're cleaner in the cap table. We can assist with roll-up strategies, decreasing the amount of equity that needs to be issued to acquire a business. And it's, several positive acquisitions can quickly change public market sentiment on stock price. But further, as private lenders, we have a lot of flexibility on what our loan looks like. We can dress it up to look different. And for example, we've funded opportunities before where we've decreased interest to single-digit rates and then added in a semi-annual facility management fee, which is really just a true up for the return we're looking for. And this creativity can go a long way in public sentiment of the financing a company receives. Search funds have made a very strong comeback over the past 8 months, especially, again, given numerous baby boomers looking to retire. Searchers are often, though, first-time entrepreneurs who've got some investment banking or private equity experience, and they may not have a ton of capital behind them. But by leveraging private debt in these transactions, they can minimize the total amount of equity needed to close the deal and keep more for themselves. Outside of that, as mentioned before, we can look at EBITDA negative businesses as previously described. And this is another example where we may come in and we may only be a bridge lender for 2 years before we're taken out by a bank. And then finally, as private debt lenders, we have more leeway over the types of industries we can look at. Some lenders and investors are precluded from specific industries. A simple example is cannabis. When that began in a big way a few years back, many of the banks were unable to lend against it, as were US lenders, given regulations. But other examples outside of that is, I came from Roynet, and oftentimes there'd be concentration limits at banks for certain sectors where it'd be very difficult to get deals through. But it could also be that a capital partner just doesn't understand it yet. It could be blockchain related or, AI in the earlier days. But as private lenders, we can take time to understand these industries and be rewarded for doing that. And a great example of where we've been doing that lately is lending to general partner créé. So this can be applied across a number of asset classes, such as even VC partner créé. But where we've done a couple deals is on real estate developers who have funded a number of projects through a limited partner, general partner structure, and they've built up significant carry as those projects were further developed or rezoned or renovated and released at higher rents. And what we did is spent a significant time reading through the limited partnership agreement and understanding how this carry works. And then we lent against it on a loan to value calculation. And what this means is that the developer didn't need to sell any of their properties in order to realize liquidity from them. They can continue to have those properties appreciate, and they can plow that new money that we've lent them back into the market to purchase additional properties. Any private lender loves seeing a deal with perceived risk, because most of the time, many other lenders or investors won't put in the diligence to understand it, because life is short and there's a tremendous number of deals going around the market. But when you do, you realize that you're getting a great deal with strong risk-adjusted returns just for putting in that work. So obviously, I'm quite biased towards the benefits of private debt, but I also understand it's not the best solution for a given situation. So to ensure I'm talking about both sides of the coin, I'm going to run through a few of the downsides in situations where private debt doesn't make sense. So first, comparing private debt to equity. So previously, I mentioned that valuations are at all-time highs. We've seen companies get strong valuations far above what they're worth, just given there's a ton of dry powder in the market. And I'll be the first to tell them to take that equity, for sure. Also, if there's a strong strategic angle from an investor, it may make a lot of sense to bring them into your cap table. Any private debt lender would be lying if they said that they would be as active as a VC who's got unlimited upside and sits on your board. We don't sit on your board. We don't tell you what to do because we don't sit on your board, but we do structure covenants. So borrowers need to ensure they can meet these covenants. For businesses that are still figuring out the drivers of the company, or if they're launching a new product, debt may not make sense. Debt really makes sense when you know what works in your company and you want to amplify that and do more of it. Equity makes more sense when you're figuring it out. Compared to chartered banks, they're obviously much cheaper. Cost of capital, they're banks. However, it can take a while to get in place. But if you prepare and you have time, they make a ton of sense. Or if you have a VC or PE sponsor in your cap table, if you're a sponsored back business, banks have great sponsor backed programs these days. They get very aggressive on leverage and at strong rates. And private debt can really only play a role there when we're looking at junior capital or as a wedge product in extending around or potentially helping to acquire a roll up. And then finally, if you're not looking for a great deal of capital, if you don't need a ton of money and you can combine smaller bank financing and government grants, then in conjunction, those two could get you through your current burn situation. And then finally, private debt itself. So the reason we're able to look at these complex situations and lend aggressively is because we look for a ton of information. We're lending towards the future, and we need very detailed data and information for our underwrite. And I can't tell you how many times we've seen a borrower who's burning capital aggressively, but doesn't have a strong financial model or understand the drivers of the business. And we need very detailed information, which if you don't have or you don't have proper internal controls means it can take a while to produce this info. So it may not be conducive to go down the path of a private lender. Outside of that, we also have covenants in place that hold the borrower to the growth that they've forecasted. So, example is if you're a tech business, we'll take your forecasts that we're lending against and we'll discount it by 25%, let's say, and ensure that you're continuing to grow and that our capital is producing ROI. For borrowers that don't have confidence in their forecast, private debt may not make sense. And this certainly relates more to the tech side of things. On reporting requirements, so we're looking for monthly reporting most of the time as we're financing working capital burn or it's a non-vanilla transaction. This can seem tedious to some borrowers. We like to think most have good internal controls and can get those within 30 days, but not everybody can. And then finally, not every lender is made the same. So the borrowers that we get the most comfort from are the ones that ask us how we've handled other borrowers who have tripped covenants, who ask us to talk about problem files and how we've reacted or what makes us different, what value do we bring. Doing diligence on your lender is very important because it is a marriage. It's not like a bank. It's a private debt lender is more of a marriage. You're looking for a partner here, and you wouldn't marry someone after the first date. So you got to ask the tough questions to your lender to make sure there's a fit. So wrap things up, we're just getting started. Private debt is not new by any means, but it's far more common and borrowers are seeking it out when looking to grow their company. We at Firepower keep growing and reacting to market demands. We recently launched an additional project called Private Credit. It's focused on check sizes 15 to 60 million for much larger asset-light businesses in Canada who have strong cash flows but are still non-vanilla. We're doing this as we believe the gap is much larger, and COVID has exacerbated that. In terms of us, our portfolio has performed well through COVID with no expected losses, and demand has never been greater for our gap debt product. And in summary, I've been here for 4 years. We truly look at companies differently. We've got several lenses to do that, and we're fantastic partners across a company's life cycle, as well as their balance sheet. I would encourage any of you, your clients or a colleague who want to learn more about our financing, invest in our fund, or just connect, to reach out to me or to Mo. I'm more than happy to connect. And with that, I will open up to any questions that you guys have.
Thank you, Trevor. And so we do have a question in the Q&A section. Bram, go ahead, Bram. We'll let you ask, and then we'll ask the Q&A question after.
Yeah, I just wondered, Trevor, about COPs. So are you taking monthly fees or quarterly? And what happens when the sponsor takes you out after 1 or 2 years? Are there penalties, and how does that work?
Sure. Yeah. So our capital. So we're a term debt provider. On the tech side, often lending between 8 and 12 times monthly recurring revenue. We're looking for an all-in return in the mid to high teens, but we've got a number of levers to get there. So in terms of cash interest, it's 12 to 13% per annum, plus or minus a couple points. There's usually some form of upside. So for earlier stage companies, we may strike warrants at some sort of fair market value, but we also have what's called a bonus or an exit payment. And this is really a plug to get the return we're looking for, and it's due at the end of the life of the loan. So instead of having a higher monthly interest rate, we'll back end our return. The length of our loans can range anywhere from 1 to 4 years in length, with 3 being the average. And the amortization, we're often provide interest only over the duration. So there's a big bullet at the end. However, we have the ability to amortize, in any way you could see fit. We have some 12 months interest only amortizing to a 50% bullet, and everything in between. And then in terms of refinancing us, so we're a fund, so we just look for clarity when doing the deal. If we're paid back out of the blue, then we typically have 3 months interest as a penalty. If we know that you're going to raise in a certain number of years, then we can structure that into the loan at the beginning, so we don't have cash drag in our fund if all of a sudden $3 million gets paid back to us out of the blue.
Okay, interesting, flexible.
So a question from one of our guests, Racine, if I'm pronouncing that correctly. Do you happen to work on a full exit as a way to finance the companies in the case where both private debt and PE financing are hard?
No, so we're lending to the enterprise value of the company, and we're not going to do 30 deals a year. So if we have a borrower that's performing well, we're more than incentivized to roll the loan forward or to provide more capital. For us, we did 8 deals last year, and we've grown with all of those companies. That's what we focus on. We don't need them to exit through VC or PE.
Bram, if you want to give some remarks regarding the club, and then we can maybe close off from there if there's no further questions.
Sure, thanks, Sagar. Trevor, this was very interesting. The first time I think we've had a webinar or even a meeting on private capital or private debt, which is very useful, obviously, in our day-to-day dealings with clients. So thank you for that. It's highly useful. Thank you for sharing it with everybody. For the club, we intend to. This was webinar number 81 since last April, and we took off 6 weeks last summer, which we will do again this summer, and about 5 weeks at Christmas. So we've had a lot of webinars. We'll probably wind up around 90 by the end of June. We have several more in the planning, and there's also in your mailings, you will get it. Richard, if you want to ask a question to a former Roynat man, Trevor, feel free. Anyway, just to a few more comments on the club. We are going to, we have planned the gala, the M&A Awards Gala for Quebec, focused on Montreal, of course, but accessible to Quebec. But if any of you out there who are not in Quebec have deals in 2020 that had a Quebec component, be it an advisor, a company, or whatever, please feel free to send in a nomination form. The nomination form is online. If you don't find it, reach out to me or to Lorene, I think it may also be on LinkedIn. You don't have to be a member, and it's a very big, it's a 400-person cocktail and dinner at the Windsor on Peel Street in Montreal, and it's become a really key event in the M&A calendar for the industry in Montreal. Starting with the Caisse de Dépôt, our pension fund, and on down. It's the highest level people in M&A are there. Some of the deals, which we generally don't discuss in our meetings, of course, in the hundreds of millions. We had a deal of 2.3 billion Canadian. So the nominations in 2019 reached over 6 billion. The first year was 2 billion. The second year was over 3 billion. The third year was over 6 billion. And then, of course, in 2020, we did a video presentation of the gala, and that's another story, and hopefully won't be repeated. But November 18th at the Windsor, we will do a Toronto or Ontario awards gala in 2022. That's definite. And we will also do our all-day forum March 18th, 2022. We will not do a forum this year in Montreal. Okay, so that's what's happening. We also are planning right now for a New York City opening of a chapter as soon as we can have a meeting, as soon as regulations allow. We will have a meeting in New York, hopefully this fall, and that will signal a whole new expansion. So thank you everybody for participating.
We do have, Bram, sorry, one last question on the Q&A board here. Hey, Trevor, could you explain in more detail how Firepower could use warrants as an upside enhancer as opposed to a bonus payment?
Absolutely. So the way we view warrants, and again, we don't need to strike warrants. I'd say about 40% of our deals have them. We view it as creating a true partnership between us and a borrower. Your incentives are aligned because you share in the upside. And really the way that we would strike that is at some form of fair market value. So as companies grow, we might strike it at 15 million, for example. That's what you're worth today. And we'll call it 1 to 3% of the growth that we help create going forward. And this results in a lower overall contractual cost to capital through the interest rate in our term sheet. And again, really positions us as true partners. It's when you win, we win over time.
Perfect. Thank you, Trevor, for that. So I think that's it in terms of questions as we have right now. Bram, any final comments, and then we'll close off here.
No, just thank you very much, everyone, and particularly Sagar, thank you for organizing this and keeping up the beat. We will, you'll be getting more mailings weekly about the upcoming webinars. There's some pretty interesting stuff coming up. So thank you very much, everyone. Stay safe.
Thanks, everyone.
And
thanks, Trevor. Really appreciate it.
Hopefully Ontario will open up as quickly as Quebec.
Hopefully. Moritz as well. Thank you so much for organizing and bringing Trevor to come out and speak.
Thanks, guys. It's great.
Okay.
All right, everyone. Have a great afternoon.
Take care, everybody.
Thanks.